The Big Short's Michael Burry is currently forecasting a significant stock market meltdown for 2022. For today's video, we will be going to talk about Michael Burry warns everyone about the 2022 recession. Interested to know about Michael Burry's tweets about the US economy, the Fed's loose monetary policy, the looming consumer recession, and just how bad the stock market could get? Just keep on watching. The Federal Reserve increases the rate. The Fed is currently in high gear. Their next meeting is actually scheduled for 26th and 27th of July, precisely around the time that this video is released. Many experts anticipate at least another 0.75 points, and some predict a full percentage point increase in the federal funds rate. Sadly, the situation's reality dictates that interest rates increases will continue until the Federal Reserve's target inflation rate of 2% per year is once again reached. Therefore, there will still be a lot more to come. But in truth, these rates increases just reflect how difficult the economy is becoming for both consumers and companies. Therefore, when loan obligations increase and life's essential become more expensive, consumers have less disposable income. For businesses, this results in decreased profits at a time when their debt repayments and other expenditures are also increasing. Burry predicts the recession. Many are forecasting that a terrible recession is just around the corner for America. Michael Burry, the man behind the myth and legend, is one guy who saw all of this coming. Nevertheless, after forecasting all of this at the beginning of last year, he recently stated that, in his judgment, we're just halfway there. He recently tweeted, quote, "Adjusted for inflation, 2022 first half S&P 500 down 25 to 26%, and Nasdaq down 34 to 35%, Bitcoin down 64 to 65%. That was multiple compression. Next up is earnings compression, so maybe halfway there." Unquote. And Burry is predicting that the S&P 500 will likely drop to a value of around 2,800, which is fairly ridiculous projection. So what is he referring to? In that tweet, he mentions two elements, multiple compression and earnings compression, that both work to drive down stock prices. Inflation hits 9.1%. The stock market hasn't exactly been a pleasant place to be in 2022, and that much is obvious. The Nasdaq is down 27% and the S&P 500 is down approximately 20%. And based on the recent news reports, it doesn't appear like things will get any better anytime soon. Just like last week, we learned that the US annual inflation rate had risen to 9.1%, with 1.3% increase from one month to the next. We have seen nearly 8 months worth of inflation in just 30 days. Keep in mind that the Fed targets an annual inflation rate of 2 per year. If you look closely at the data, a significant portion of that inflation can be attributed to the energy crisis we're presently experiencing as a result of Russia's invasion of Ukraine and the global response to that invasion. The energy category in TUNEP 7.5 was by far the worst month over month, and when it is broken down further, we notice that energy commodities are up to 10.4%, gasoline is up 11.24%, and utility gas or pipe gas is up 8.22%. Large rises, and it should come as no surprise that this increasing inflation has led to large increases in interest rates. Earnings compression. However, he suggested we are just halfway there, and he believes that profit compression takes over at this point. Therefore, lower corporate profits in corporate America will likewise drive down prices, rather than a decline in investor confidence. This relates to what we previously said. You already know that interest rates are rising as a result of the excruciatingly high inflation rate. However, in practice, it implies that customers have less extra money. He tweeted, quote, U.S. personal savings fell to 2013 levels, the savings rate to 2008 levels, while revolving credit card debt grew at a record-setting pace back to pre-COVID peak despite all of those trillions of cash dropped in their laps, looming a customer recession and more earnings trouble, unquote. Multiple compression first. What Burry believes we have already witnessed. How does this apply? Of course, the price-to-earnings ratio is the most widely used and straightforward valuation indicator. There are earnings per share divided by stock price. If the stock price is $20 and your company owns $1 per share per year, your PE ratio is 20. But we can also rewrite this equation to say that stock price equals earning times the PE ratio, or alternatively, the earnings multiple, which refers to the multiple of earnings that investors are ready to pay for the stock. In actuality, this data stops at the beginning of this year, and as earnings have remained solid so far this year despite the market's sustained decline, this line is expected to continue declining through 2022. Michael Burry refers to the phenomenon as multiple compression. In equality, it's just another way of indicating that investors' confidence is declining. Investors were willing to pay more than 35 times the S&P 500's earning last year in order to possess it. As of right now, estimates place the multiple at around 20. Consequently, the market is declining as exuberance swiftly gives way to pessimism. Big money buys bonds when rates rise. That is the key to learning. It is also impacted by interest rates because when rates rise, new bonds appear more alluring, and large sums of money start moving from the stock market back into the bond market, bringing the stock market down, contrary to what has been happening over the past few years. This is the case. As you are aware, interest rates has been extremely low, and when that happens, bonds returns are essentially zero, which causes the stock market to officially inflate. The wealthy seek to invest their money elsewhere as a result. In the end, though, that is multiple compression, rising rates, and investor confidence weight. Barry's tweets is broken up like that. The Amazon indicator. Burry shingled out Amazon as one company that was having trouble in the first quarter. If we switch to simply Wall Street, we can see that Amazon's earnings were profiting well before they plummeted in the first quarter because customers weren't as eager to spend as much. Take a look. According to economists, the decline will last through 2023 before beginning to recover in 2024. Consequently, the numbers show how macroeconomics works. Since 2021, operating costs have been rising faster than usual while operations cash flow has decreased. Burry's conclusion. Now that borrowing rates have increased significantly and the average consumer is struggling, Burry predicts that corporate America's earnings will begin to decline from this point forward. Also, keep in mind that pricing is earnings multiplied by a multiple of investor sentiment. Michael Burry anticipates that throughout the coming period, and while it may be a little unsettling, there is no need to panic. You are aware that these cycles are typical and that in order to discover possibilities in them, investors must have a long-term perspective. What can you say about Burry's predictions for a recession in 2022? Which of his viewpoints do you think is the most useful? Please let me know by leaving a comment below. And if you enjoyed this video, please press the like button, turn on the notification bell, and subscribe to Wealth-ology for more videos like this. Thank you for stopping by to watch. See you in our next video.